Welcome to the Market Action Podcast for Wednesday, October 23rd. Today's story is the need to look beyond tech as new sectors rise. Hello, this is David Russell for TradeStation. It's raining bears in the technology sector. Just yesterday, we got a trio of bad news. Texas Instruments warned that chip demand was lower than hoped. That hammered semiconductors. Snap issued weak guidance for the current quarter. And ServiceNow, a one-time up-and-coming software company, lost its CEO, John Donahue, to Nike. All three stocks fell, but in some ways, that's the least of the news. The real story is that money's been trickling out of technology for a few weeks, and now there are signs the flow is worsening. Software could be the biggest canary in the coal mine. Aside from Microsoft, most companies in the industry aren't super well known or flashy, but they've been going up for years thanks to the cloud computing revolution. All kinds of work and business activities like design, HR, analytics, and customer management have shifted to online subscription providers. Quarter after quarter, companies like Adobe, Salesforce.com, and Shopify have wowed investors with steady growth. But something may have changed in the last month or so, because while the S&P 500 bounced back near its record highs, software companies were lying flat on their backs. Then last week, TradeStation's Market Insights blogs reported on a trio of bearish analyst calls in the software space, followed by more selling. Valuations are a key issue. The simple fact is that software companies got extremely expensive relative to other companies. Many trade at 30 or 40 times earnings, some even higher. Their price to revenue and price to book levels are also in the double digits. Multiples like that could have made sense for a while. But in recent weeks, investors seem to think they're just too expensive, especially now that their growth is slowing. In some ways, it feels like late 2018, when the market bailed on major technology stocks. Roll back the clock exactly 12 months ago, and all you heard was about how growth stocks like Netflix were crashing. But it might not be deja vu all over again, because this time investors seem to have found alternatives, especially financials. Many big banks traded barely 10 times earnings, and they're actually reporting growth for the first time in a while. Another thing about banks is that the deck's been stacked against them because of the yield curve. It's a little too complicated to get into here, but if the current weirdness in interest rates reverts to more normal historical patterns, it would help the banks. Strategists and value hunters have made similar cases in favor of industrials and small caps. Retailers are another group to remember, especially as we head into the holidays. All of those sectors, financials, industrials, small caps, and retailers, are outperforming technology so far this month. But still, there is an elephant in the room, a giant trillion-dollar animal we don't want to forget, and that's Apple. Pretty much the only tech stock hitting new 52-week highs recently. As Market Insights reported more than a week ago, the iPhone maker has two big things going for it right now. Price cuts have unleashed new demands for lower-end phones and the growth of services like gaming and streaming video. Don't be surprised if Apple stands alone or even becomes a refuge for tech investors if the broader sector keeps struggling. Still, a bigger rotation seems to be underway. Unlike a year ago, this time other stocks are rising as the Nasdaq comes under pressure. Will these recent outperformers become new leaders in 2020 if the S&P 500 breaks out? More importantly, will you be ready if it happens? Thanks for listening to the Market Action Podcast. This has been David Russell for TradeStation.
The preceding podcast was for educational purposes only. All of the symbols and trading ideas discussed were for demonstration purposes and not recommendation. Active trading is not suitable for everyone. You can find additional disclosure information on the TradeStation.com website. Thank you for listening.